Let's say it's 2021. You sign a contract to buy a pre-construction condo in Toronto for $1 million. You hand over a $200,000 deposit and wait for the building to go up. Look at this timeline comparing that 2021 purchase to today. By the time the developer hands you the keys in 2025, the local real estate market has cratered. Your exact unit is now only worth $800,000 on the open market. That original $200,000 deposit, it is completely wiped out by the drop in value. Here is where the math traps you. To finalize your mortgage, federal banking rules require you to hold 20% equity in the property based on its current $800,000 value. Since your first deposit evaporated in the crash, you suddenly have to bring an extra $160,000 in cash to the closing table. If you don't have that cash lying around, the deal collapses. You forfeit your original deposit entirely, and the developer can legally sue you for breach of contract to cover their own financial losses. This is a structural failure built directly into the delayed timeline of pre-construction real estate. Buyers lock in a price years before they actually secure the loan to pay for it. Multiply that individual math across the entire Greater Toronto Area. Right now, there are roughly 92,000 units under construction facing this exact valuation gap. This flowchart illustrates the expected chain reaction. If thousands of buyers walk away because they can't close, developers lose their funding and go bankrupt. That leaves major banks holding billions of dollars in unpaid construction loans for half-finished buildings. But if you look at the actual closing data, that mass collapse isn't happening. Even with unit values down 20 to 30%, these severely underwater buildings are still successfully closing and transferring ownership. The banking system has quietly deployed a mechanism to keep the money flowing, entirely ignoring the mathematical reality of the open market. That mechanism is a banking procedure known as a blanket appraisal. This diagram compares the two approaches. A standard appraisal calculates exactly what a specific unit is worth today. A blanket appraisal skips that step entirely. Instead, the bank agrees to value the property at the original contract price you signed years ago, essentially copying and pasting a peak 2021 valuation onto a 2025 mortgage. Let's look at why this matters under the law. Canada's Bank Act states that uninsured mortgages cannot legally exceed 80% of a property's market value at the time the loan originates. By substituting the inflated contract price for the actual market value, the math artificially satisfies that 80% rule. The denominator in the equation is swapped out, making the loan look perfectly safe on paper. This regulatory loophole takes a high-risk loan that would otherwise violate federal lending limits and transforms it into a fully compliant mortgage. Why would major Canadian banks willingly accept an artificially inflated appraisal on an asset that is actively losing value? The banks have their own exposure to worry about. They hold massive $500 million construction loans. Getting repaid relies entirely on the developer successfully finishing the building and closing the units. It is a massive single point of failure. Watch how this chart redistributes the threat. From a risk management perspective, the bank prefers fracturing one catastrophic $500 million developer default into 200 separate, smaller mortgages held by individual citizens. By ensuring those individual deals close, the massive construction loan gets paid off. The risk is completely removed from the bank's corporate ledger and the developer's balance sheet. The blanket appraisal acts as an institutional risk transfer switchboard. It is designed exclusively to protect the lender and the builder by passing the financial hazard down the line. Let's look at what this means for you on the day you pick up your keys under a blanket appraisal agreement. You are taking on an $800,000 mortgage for a condo that is currently worth exactly $800,000 on the open market. You are starting your homeownership journey with zero actual equity. If you fall behind on payments, lenders in Canada rely on a process called power of sale. If the bank forces a sale and the condo sells for less than what you owe, they can still legally sue you for the remaining shortfall. You are completely boxed in. You cannot sell the property without bringing tens of thousands of dollars to cover the loss, and you cannot walk away without the bank chasing you for the outstanding debt. As the end consumer, you have absorbed 100% of the market crash's impact. Your financial buffer was sacrificed so the developer and the bank could walk away without losing a single cent. This NAT models the macro impact across Toronto. Thousands of these underwater mortgages are being processed right now, keeping official closing volumes up and artificially propping up the city's real estate data.
Propping up valuations through blanket appraisals creates false price stability. It delays the natural price correction that the market actually needs to restore baseline housing affordability. If these trapped buyers eventually buckle under the weight of their loans and default en masse, the final backstop isn't the bank. It's the Canada Mortgage and Housing Corporation, or CMHC, the federal crown corporation that insures these loans. That means the Canadian taxpayer will absorb the final blow. Blanket appraisals are keeping the construction industry solvent today, but they are doing it by forcing everyday citizens to quietly subsidize the losses of a collapsed housing bubble.